Good afternoon. Are we ready to go here? Okay. Hi, everybody. This is Eric Anderson at SEDCOR. Thank you very much for being part of this kind of continued experiment on how we do our own retooling here to try to figure out how to present you with good information during these times of self-distancing and social distancing. We're coming to you from several different locations around the Willamette Valley this morning, but we'd certainly like to thank you for taking the time to be part of this. Sorry you're not getting your lunch and networking out of it, as per usual with our business forums and particularly our economic forum, but we're thankful for you to be part of this today, and hope for your continued support as we try to offer these information sessions. There's a lot going on, obviously. There's a lot of information that's out there. What we're trying to do is really reach the businesses that we're most connected with in the region, our traded sector, our growers, our business support services that are so vital to our region, and try to have events like this to really provide you with good information and as up-to-date information as we can be getting right now in a very kind of difficult time with a lot of things being thrown at us. Hopefully SEDCOR is able to at least provide some clarity and some priorities as far as the information that reaches you. We look forward to being able to do this once again in person over lunch, but bear with us as we go virtual for these. Today we will be hearing from Tim Dewey of the University of Oregon. We're very excited about that. We have a Q&A feature here on Zoom, so please ask questions via the Q&A function. Michael Miller will be an ominous voice coming out of the void, and will be moderating the Q&A when the time comes to go through those with Tim. I would also please try to keep questions brief and direct, a little bit easier to manage the Q&A queue on the Zoom program. Also would love to take the opportunity to thank our sponsor for kind of joining in with this experiment here, the Oregon State Credit Union. Patrick Schmerber is their representative, and he's working out of Woodburn this morning, or I guess afternoon. So Patrick, I'd love to have you say a few words and before we introduce our speaker.
Thanks, Eric. Thank you all very much for the opportunity to be here this afternoon and to talk with you. Like Eric said, my name is Patrick Schmerber. I'm the branch manager at Oregon State Credit Union of our Woodburn location. Oregon State Credit Union serves over 119,000 members in the 24 counties that we operate. Our vision at Oregon State Credit Union is creating financial solutions to make lives better. To that end, we've been hard at work during this challenging time that we're all in. We are participating in the now notorious Paycheck Protection Program. We have served over 266 businesses who are our members with loans averaging $68,000. The total amount was $18.2 million that Oregon State Credit Union was able to secure for those businesses in our communities so that they can continue to work and continue to provide jobs for their employees. On top of that, Oregon State Credit Union has offered over 5,600 no penalty payment deferrals to its members during this challenging time. We've assisted 39 folks with mortgage relief and have created programs to assist our members with things like emergency loans so that they can meet their daily needs. We continue to work to follow our vision of creating financial solutions to make lives better and work really hard to provide an unsurpassed member experience to our membership. With that, it is my pleasure to introduce our speaker today. Tim Dewey is an economics professor of practice at the University of Oregon. He got his BA in economics in 1991 from Puget Sound University, and then later his master's and PhD from Oregon, the University of Oregon. That's my alma mater, by the way. Don't tell my bosses, that might come up on my review later. He worked in Washington, D.C. after school at the United States Treasury as an economist for the International Affairs Division and later the G7 Group, a political and economic consultancy for clients of the financial industry. In his latter position, he was responsible for monitoring the activities of the Federal Reserve and currency markets. He returned to the University of Oregon in 2002 and is the Senior Director of Oregon Economic Forum and the author of the University of Oregon Statewide Economic Indicators, Regional Indicators, and the Central Oregon Business Index. Tim is published in the Journal of Economics and Business and is currently a member of the Oregon Governor's Council of Economic Advisors and State Debt Policy Advisor Commission. He was called influential by MarketWatch. His blog, Tim Dewey's FedWatch, is listed as one of the top blogs to watch for economic news. So with that, let me turn it over to Tim. Thank you.
All right, well, thank you very much, Patrick. Appreciate that intro. I'm going to bring up my screen here and share that with everyone. And start slide. Okay, so I think that that should bring up my slides. So I've been calling this the 3Ds of depression. Sorry if that sounds depressionistic, but that's kind of the situation we're in. So we're just going to jump right into this. You know, somewhere in January, maybe even early February, we could view this as something of a supply side shock. So people were talking about the impact of COVID-19 as really being an impact to China's manufacturing sector, and then that was going to impact the capacity of U.S. firms to operate without, raw materials and without intermediate goods. That story has completely changed. Now clearly the story is something that's much more of a demand shock. And the demand shock stems from the fact that we've closed large sectors of the economy and we just can't shift spending into a different part of the economy. It just doesn't work that way. Goods are substitutes, are not substitutes, but they're complements. So if I can't go travel, if I can't go to a restaurant, if I can't do those types of things, then there's other things I won't do as a result. I can't buy gas, sporting goods, cars, all the things that would normally associate with those types of things. And then certainly if we think of input-output relationships, there's even more complementarities in the economy. A restaurant shut down uses fewer accounting services. So what we're really unfortunately seeing is this broad-based hit to demand that's in some ways just simply unexpected and certainly unprecedented. The first data that we've been getting is fairly dismal. So one thing I like to make a point on is that there's no leading indicators for this event. Typically, ahead of a recession, we could spend a year or maybe even longer sort of parsing the data and debating whether or not a recession is happening and thinking about what policy responses we might do to prevent a recession. We're just way beyond any of that this time. We deliberately closed the economy. What we're seeing is the immediate effects in the data, and it's completely, it's completely without any leading natures in the data. So initial unemployment claims being a big one that we focused on. We're seeing initial claims rise as high as 7 million a week. That's essentially 10 times what we saw in the worst of the Great Recession. And that has, so we've seen numbers like that continue for a number of weeks. And we're also seeing that in personal consumption expenditures. So a lot of the data that we have for a lot of the data we have for this national number are what we call annualized. So it's the percentage change annualized, which means if you continue to change at this pace for the entire year, consumption expenditures will be down 60%, more than half for the entire year. Now that won't happen. Actually, we probably saw a bottoming out of consumption activity in this last quarter just because of the severity of the drop in the second quarter. But you get to see how the impact on these numbers when you have a one-time shutdown of the economy of this magnitude. We're seeing this in other parts of the economy. So manufacturing activity, for example, is moving into recessionary type of numbers. Whether it be employment, production, new orders. These ISM manufacturing numbers are kind of interesting. The composite number in the upper left-hand corner here is not as bad as you normally see, and not as bad as you see in the other components, because one of the factors holding that up is supplier deliveries have fallen, and you typically see that happen during really robust economic periods because people can't keep up with the orders. Here you're seeing it happen because of supply chain damage. Is firms can't actually do the production they need to do because maybe they're slowed down, delayed, or stopped because of COVID-19. So what we're seeing is a broad-based shutdown of economic activity show up in some pretty clear and distressing labor market indicators. So the unemployment rate, for example, has now risen to 15%, 14.7% in the US. We lost 20 million jobs last month. So if we think about what creates a depression rather than a recession, one of the elements would certainly be the depth of the downturn. And that's certainly something we have going on right now. We have a fairly severe, deep downturn that would be consistent with what we think of as a recession, or excuse me, a depression. You're going to continue to see this come in over the numbers. Real gross domestic product, for example, national output for the first quarter was down at an annualized rate of over 4%, largely due to consumption. What we're going to see is that's going to accelerate in the second quarter as we add in effects such as lower investment spending. There's probably going to be a slowdown in the housing starts that we've already seen, so lower residential spending. So you're going to see, I think, the weak data is certainly going to continue here for the time being. So this is not just a national phenomenon. I'm sure all of you are experiencing this to some degree in Oregon. My Oregon Index of Economic Indicators has fallen quite sharply. Again, usually this would lead a downturn by 6 months. It's not leading this time. It's falling in line with the downturn. Mostly this is the initial unemployment claims rising. This is from March. A lot of the data for February and March was still pretty solid. It's really April that's going to start taking the hit. And when I look at the Oregon measure of economic activity, that is also softer as well. Again, this is measuring the growth of the economy. So not only is the direction down, the growth is likely to be slower here going forward. So, clearly the story here is one where we see a very deep, dark period of time right now from the economic point of view. Now, again, that should have been expected. It's almost, reality is that if it didn't happen, our policies wouldn't have been working, right? We shut down the economy deliberately in order to control the spread of COVID-19. If the data didn't reflect that, then we didn't shut down the economy, and then we weren't controlling the virus. So now the question is, we shut down large parts of the economy. We're going to start reopening the parts of the economy. We'll talk about that a little bit later. How long should we anticipate this downturn lasting? So that moves us from the depth of the downturn, which we know is very severe, to the duration of the downturn. And that becomes really what the principal issue that we're facing right now is. When economists look at this, we're kind of forced into what the epidemiologists tell us. Right? If you tell me what's going to happen with the course of the COVID-19 infections, then I can give you some sense really of what's going to happen with the economy. A lot of this really depends upon how much we can restart the economy and how quickly we can restart the economy, which then in turn depends upon how long we have to maintain some form of severe social distancing measures. What we're learning is that it looks like, given where we're at right now, we're looking at a year or longer fairly severe social distancing measures, and our economy is going to have to be adapted and adjust around those social distancing measures. And some sectors of the economy that rely on dense crowded events simply are not going to be able to operate for the time being. And that becomes the real challenge here is how do we support firms in that between period of time? How do we support individuals in between that period of time? And how do we do that in such a way that minimizes damage to the economy, that creates lasting effects? I like to emphasize that if we back off of restrictions too quickly, if we reopen the economy too quickly, then we might have to reshut the economy down in 2 or 3 months. And that's something we want to avoid, because then all the work we did now is going to be wasted. So we really have to think carefully about how we move forward, how we coordinate state, local, and businesses in creating an effort to allow us to move forward. It needs to be something that is at the top of our agenda. Right now, we want to sort of maintain the situation where infections are low in the state, and thereby enabling us to do some levels of reopening. Okay, so what's this going to look like for the economy over the next year or longer? So this is a stylized graph of possible outcomes put together by the Office of Economic Analysis. And what we see at the beginning of this is a fairly steep drop-off in activity, and that's the stage we're in right now, where employment's going to be down 20% or more from the peak. And this is in Oregon and the US. We're going to follow similar paths. Soon, sometime in the third quarter, we're going to see activity start to bounce back. It's mathematical fact is going to happen. We've seen some levels of activity drop to basically zero. And as soon as we lift some restrictions, those types of activity are going to move from zero to something positive, which are huge percentage gains. So you think of sort of restaurants that are shut down entirely that find a way to start operating in the third quarter, or you think of any kind of travel activity. So basically airline travel has fallen to as low as it's going to go, and it's starting to edge up. So when that kind of shift happens, mathematically, the data pops. You'll see a slower pace of layoffs, you'll see some rehiring, you'll see consumption growth numbers pop up, GDP growth numbers jump up. What I try to caution people on is this is not necessarily the beginning of a full-on recovery. It's really, again, the fact that you stop falling. In financial markets, it might be akin to what you'd call a dead cat bounce, when the markets fall to the bottom and they pop up a little bit. What's really interesting is really what comes after that bounce. What comes after that bounce is, again, dependent upon how we're able to control the virus. I think as we've gotten longer into this, it becomes more evident, again, that certain parts of the economy are not going to recover very quickly, partially because of restrictions we're putting in place that prevent the economy from jumping back very quickly. Also because of some of the permanent damage that's going to be done between now and whenever we can sort of fully renormalize activity. So one of those forms of permanent damage, to the extent that employer and employee relationships are broken, there will take some time to resort the workforce back to the fact that we have firms and new employees. So that's going to take some period of time. we also worry about employee skills deteriorating during a period of unemployment. So that's one factor. Another factor that we're facing is the fact that a lot of firms are going to go under. So a lot of firms just simply, if you had a weak business plan going into this, you're going to have a hard time operating in this environment. And we see that in some manufacturing sectors across the U.S., where you'll start to hear stories. Now this firm is shut down. They're not going to reopen. They're going to consolidate their operations to some other place or some other country. And that's something that we're going to see, and it's going to take some time to work our way through. And similar issues are going to happen in leisure and hospitality. These are sectors that are probably largely impacted more so than other sectors by the fact that we're not going to be able to do dense, crowded types of activities for some period of time. So you're going to see a lot of turnover in, for example, restaurants. Relatedly, we're going to see a lot of turnover in retail. There's going to be a shift or acceleration toward online purchases. And that's going to, again, hamper marginal retail retailers. The consequence of less restaurants in the near term, less retailers, is obviously going to filter through to other parts of the economy. So commercial rents, commercial real estate activity will be slow as a result of this. Going forward, you might see less demand for office space. That could also change up the dynamics around commercial office space, or commercial real estate. So those are the kinds of permanent damage that we're expecting as we move forward, and that's going to slow our ability to rebuild the economy. There's also going to be weights on international trade. The world just suddenly got smaller is one factor. This is not just a US event, this is a global event. The global economy is going to be weighed down by these events, by the COVID-19, and that's going to drag down US exports and US international trade. So looking forward, it's hard to see a rapid return to the kinds of activities that we had 3 or 4 months ago. Again, early on, we could think about this as maybe a very short-term event. You turn the lights off, you turn them back on. Maybe that could happen after a 2 or 3 week shutdown. After 2 or 3 months shutdown, that becomes much less likely. Now it's more like turning on a dimmer switch and seeing parts of the economy light up and parts stay dark. This has some significant long-run consequences. This is another hypothetical possibility of what could happen going forward to illustrate the impacts of these shocks. On the left, we have the great financial crisis. And we saw is output, the yellow line, fell well below what we think of as trend output. So where output would have gone absent the crisis. And you can see that there's a fairly long period and it's sustained where you had a permanent impact. There was permanent damage to the economy. Output was permanently lower as a result of the recession. The hope always was, this is from a month ago, that we wouldn't see that permanent damage. So that's what the graph on the right would look like. I think it's harder and harder to say that graph on the right is what's going to happen. The reality is, again, there's going to have to be some restructuring in the U.S. economy that's going to happen after this. That's going to impact our ability to operate as we were prior to the crisis. So we have the depth part of a depression. We might have the duration part of a depression too. Unemployment rates have, even 10% for a protracted period of time, even unemployment rates start to come down, would be a depressionary type of event. Maybe not like the Great Depression where we had 30% unemployment rates and high unemployment rates for a long time, but this is a modern day equivalent of that. So depth, duration, and then there's deflation. Deflation is another problem that the economy often faces in these kinds of situations. Deflation aggravates a recession because nominal debts become harder to service. So there's a reduction of national income during this periods of time. So if you're a business owner, for example, and you have loans to pay, obviously a slower pace of revenue means that you have a higher debt burden. The same happens for consumer spending as well. So households lose a job, or their income falls, wages fall even for households that don't lose a job, and as a consequence, it's be more expensive to service their mortgage in real terms. So it tends to be in these environments that we see a slowdown in spending outside of the first round effects. So there's going to be second round effects, and those will start to filter into the economy going forward. So investment spending being a critical one. So firms will invest less in plant and equipment. That will reveal itself in slower growth and slower output later on. So these kinds of severe events have lasting impacts on the economy, unfortunately. One of the sort of silver linings or bright spots, firms and workers seem to be moving more quickly toward wage cuts than we've seen in this. Wages are typically what we think of as this kind of econ speak, but they have downward nominal rigidities, which means that they're sticky. People don't like to get wage cuts. Firms don't like to give wage cuts because they worry about employer morale. And consequently, typically in a recession, wages don't fall. The problem with sticky wages is that enhances unemployment. Basically, firms find themselves with very expensive labor, and so they cut a few workers rather than lowering wages for everyone. This time around, we're probably going to see enough pressure that we basically those social norms erode, and people are more willing to give and get wage cuts, and that will hopefully minimize some of the decline in unemployment. So we're starting to see some broad-based deflationary pressures. So this is our core personal consumption price index, which is the Federal Reserve target. We also yesterday had consumer prices. Both those have been showing negative readings in recent months. So what's happening is, again, a typical collapse in demand, and that typical collapse in demand brings about the typical result of declining prices. You might see some stories about certain goods that are going up in price. So I saw, for example, home gym equipment was going up in price because people were transitioning away from the gyms to basically home-based exercise. So that's an example where prices for a particular good might go up, even though in general there's downward pressure on the overall price level. So this is something that we're really watching for to see to what extent we have, again, one of these key a hit to demand that would signal that this is more than just a temporary recession, but more of a protracted depressionary type of event. All of these things are heavily influenced by policy, duration and deflation in particular. So where we're going to go from here is going to be dependent upon how sustained we can have federal policy, both fiscal and monetary policy. The monetary policy, I'm not terribly worried about. The Federal Reserve has been in basically full gear since day one of this crisis. So what's happening there? The Federal Reserve is really working hard to prevent the financial system from collapsing. So those of us that have been through the last couple of recessions might remember that the last two recessions really originated in the financial sector. So we saw shocks to technology stocks In 2000, fit into the 2001 recession, and we saw the housing crisis being a financial crisis that then spilled over into the rest of the economy. So those were financial shocks that spilled into the real economy. This is a little bit different. This is a real economy shock that spilled into the financial sector. What the Federal Reserve is doing is trying to contain that within the financial sector so that you don't spill it back into the real economy. So this is really a critical element in preventing a recession from becoming a depression. What we saw in the 1930s is policymakers sort of stepped back from their role of, sustaining the financial system. The financial system collapsed, and then lending capacity collapsed throughout the economy as a whole. So if we want to avoid that outcome, which the Federal Reserve most definitely wants to avoid that outcome, what they do is make sure there's a free flow of credit in the economy so that those problems on Wall Street don't aggravate the ones on Main Street. They know this is a hard story really to tell people, because it's hard to say, what the Fed's doing might not be helping you directly, but it's certainly helping you indirectly. But it's hard to prove the negative. It's hard to reveal to people that the story of what would have happened if you didn't have this kind of activity. So the Federal Reserve has been working to maintain smooth functioning in financial markets, and also to try to provide lending programs that move around any roadblocks in the system. Optimally, what the Federal Reserve would like to do is basically say, we're not going to let the financial system collapse. And by doing that they might not actually have to do much at all. So for example, Boeing was able to issue a bunch of debt and get funding without the federal government help, without the Federal Reserve directly buying any of that debt. And the reason they were is because the Federal Reserve said, we're not going to let the financial system collapse. We're going to be a buyer of last resort if necessary. And then everybody recognizing that said, okay, well, that's great. Then we can go ahead and buy this debt. And that's a good space to be in right now. I think one thing to keep in mind is that nobody's to blame here. There's no moral hazard problems really to worry about. This isn't like 2007 where we could point to the bankers and say, oh, you did bad things. You encouraged people to take these bad mortgages. You made these bad products. This isn't that kind of situation. Same thing I would say for firms. I don't know of a lot of firms that could possibly survive for a 100% drop in your business for a period of 6 months, which is basically what the airlines are facing. You just don't have that kind of foresight for that kind of disruption. So this is where you have a role for the Federal Reserve or the federal government to come in without really creating any moral hazard concerns, because nobody did anything wrong, at least in the private sector, to create this disruption. So monetary policy in full gear to try to maintain the financial sector. It's for all intents and purposes coordinated with fiscal policy. So the Federal Reserve has basically sent a very clear message that they're not going to raise interest rates anytime soon, so Congress can issue as much debt as they really want to. So the Federal Reserve is not going to offset that. Fiscal policy, I would say, has been moving in the right direction. One of the big issues is, how do you keep nominal incomes in the economy high during this period of a downturn? We want to keep nominal incomes high to prevent some of these deflationary problems. So for example, we know that rents need to be paid because landlords need the rent to pay the mortgage, their mortgages, their commercial mortgages, and that needs to happen to pay the servicers, and that needs to happen to pay the investors. So there's a channel that needs to be constantly fed, a flow. And you don't want to disrupt the flow. So you've got to find places in the system to make sure you don't disrupt the flow. And one of the easiest places to do is to give unemployment insurance and large amounts of unemployment insurance to make people as whole as possible so that they can cover their obligations and thus keep those financial flows churning. And by keeping those financial flows churning, you hold up nominal income of the economy as a whole. So the enhanced unemployment benefits were an excellent plan. In my opinion, the plan hit a snag in the fact that state employment agencies were in no way, shape, or form capable of handling this kind of deluge of claims. I mean, the system was built for, if you thought the perfect system would have been designed for your worst case scenario, and your worst case scenario is what we saw during the Great Recession, well, we just saw a worst case scenario that was 10 times the magnitude of that. So the system is not exactly designed for this kind of disruption. The payroll protection plan had a similar kind of problem. That SBA lending, I'm sure you either participated in or heard about. Unfortunately, because of the way it's interacting with unemployment insurance and the timing of the two, the SBA program will be mostly beneficial to firms that were able to or close to able to limp along this crisis, and get to the other side of this still largely intact. It'll make it easier for those firms. A firm that had already laid off workers would find it harder to use that payroll protection plan to reinvigorate their business, especially since if you already laid off workers, when the 8 weeks of payroll protection is expired, you'd probably end up laying off those workers again. So that program has not been perfect. All of these ideas were good. The execution did not happen as intended. Although continuing claims here are somewhere around 23 million continuing claims a week. If each of those is on average, say close to $1,000 a week in benefits, that totals up to say $23 billion a week, which is actually a huge number to try to support incomes. I think that some of this is kind of underrated in the power that it's going to have to help support, again, these financial flows within the economy. And so this was good, certainly good policy. I think one of the issues here is how do we sustain that going forward? This policy was really designed to address a fairly short-term event. This is going to be a longer-term event. So I would hope that Congress would start to say, okay, well, we might have to extend these programs and we should phase them out as the unemployment rate falls. So, instead of putting time limits on these things, put economic objectives on these things. I think would be helpful going forward. We also need state and local aid going forward to help minimize these recessionary type or depressionary type dynamics. By some estimates, actually, labor income will be fully offset by fiscal policy in the second and third quarter of this year. So again, that would be a fantastic in helping to support activity going forward and the recovery efforts after we get deeper into the reopening phase. Okay, so I'm going to keep talking here. This is kind of a new experience for me because I'm not seeing your reactions. I'm probably supposed to be telling more jokes, but then I can't see anybody laugh, so I don't know if those would fall flat. I'm going to finish up here in the next few minutes and then take some questions. I want to talk a little bit about reopening. One of the one point I try to stress is the governor of this state or any other state doesn't really reopen the economy. We, as the consumers, reopen the economy. When we feel it's safe to go out and participate in economic activity is when we're going to go out and participate in economic activity. So far, we've seen broad-based support for Oregon stay-at-home orders. And this crosses party lines as well. So, 82% of Oregonians have supported the stay-at-home orders. Even those that oppose it, you don't know how many would actually just stay at home anyway. Out of safety concerns, they might just oppose the idea, but would behave in a similar fashion to begin with. So the fact that there's broad-based support for this suggests that there's broad-based concern about people's personal safety should they participate in their pre-virus types of activities. And we also see this in how long people will forego events, until they feel safe again. So like, it'll be a median of 6 months before people are willing to attend a major sporting event. So it means half the people surveyed would say, yeah, I'm not going to attend a major event for more than 6 months. 2 months though for a haircut, for your haircut at a barbershop or salon, right? So that tells you what people's priorities are. They really want to get a haircut, and I appreciate that. Interestingly here, I mean, things that are staying in a motel, traveling on an airplane. Again, these are activities that directly impact the leisure and hospitality industry. And this is where we see the potential for some long-lasting impacts is leisure and hospitality, just because these are the things that seem to be related toward the more rapid spread of the virus. So those types of things, or congregate living situations, or congregate work situations. So for example, food processors have been problems controlling the spread of the virus. So anywhere where you see having an issue controlling the spread of the virus, that's where your costs are going to be higher, your recovery is going to be slower. But this really speaks to the travel and tourism industry and reviving that industry. As I like to say, for a lot of restaurants, they have thin margins. They can't survive on a 50% capacity. Only the large chains might be able to survive on that kind of capacity, but smaller neighborhood restaurants are less likely to be able to survive on that. So that's where you're going to see a lot of turnover in that industry. I think, in a broad sense, you're going to see a lot of innovation eventually start to come out of this as people try to innovate their way around this problem. But again, that's going to be a process that requires some time. So, and another thing I like to point out is that people stopped participating in the economy before the stay-at-home orders went into effect. So whether you were an early closing state or a late closing state, the difference was a late closing state, the activity dropped off before the closure, a longer time before the closure. So, and even in states that did not have stay-at-home orders, there's been a drop-off in activity. So again, trying to press that really for, really if you want to reopen the economy, we have to work in a coordinated fashion to control the health risk. It's not either your health or the economy, it's both of those things together. So that's really what the focus of the government effort needs to be on, is controlling the risk of the economy. That's your economic development policy right now. I always get asked, what's going to be different in the future? And I'm not a futurist. I always remain wary of predicting big changes. Behavior tends to be sticky, so what tastes and preferences are going to change. If people can revert to their pre-virus activity, I suspect they'll try to do as much of that as possible. So when there's a vaccine or when there's some kind of treatment, activity would try to revert back there. Or what's going to change is, as I said earlier, there's going to be innovation that innovates our way around the problem. So people will try to find innovative ways to, again, resume the social activities that they were able to participate in prior to the virus. Certainly, though, there's certain trends that seem likely to continue. This video conferencing trend, I'm not sure that we're going to continue all of it, but we'll continue some of it. I'm not sure how much I like it. So far today, I've had 2 meetings in Portland, a meeting in Salem, and 2 meetings in Eugene. So, clearly I would not have been able to do that 6 months ago. One of these would, I'd be able to do one of those things. So this is different. Grocery delivery. To what extent am I going to go back to Costco when I realize that, Costco comes to me for the basics? And so, online shopping seems to be higher. So those kinds of trends are probably accelerated. We were in the direction of those things, but they're accelerated. Business travel is another thing to be heavily impacted for a long time. Other changes really depend upon how the virus evolves. as I said, if we're stuck with this for a while, we're going to find ways to innovate around the virus. And so that's where you're going to see, I think, new business ideas start to emerge that we're going to want to pay attention of, and firms are going to want to be able to take advantage of as they emerge. Okay, so that takes us to 12:45, and I think, right now I'd like to take some opportunity to ask some questions, answer some questions.
Tim, can you hear me?
Yes, I can hear you.
All right, I've got some questions for you. I've gotten a few questions on this. How is the spending deficits and tax policy affected your projections?
So I'm not terribly worried about the deficit projections. This seems to be a situation where there's a clear need for government support on a large scale for a protracted period of time. There's no question that you could, quote unquote, finance the deficit, because you can always print dollars. The real question is, to what extent do you run into resource constraints? When do you see inflation emerge? When do you see higher interest rates? That's where interesting things start to potentially happen. We're not seeing those things. I would say the experience in Japan shows us that the capacity for the economy to absorb this government spending is much higher than is widely recognized. And also, I think related to that is, people did not believe 4 or 5 years ago that we could sustainably get unemployment rates down to 3.5% absent inflationary pressures, but we did. To me, what that tells us is that probably for a protracted period of time, we have underestimated the ability of the economy to produce, and that's, I think, been a losing proposition for all of us.
Awesome. So what do you think are the economic opportunities associated with food security and the food supply chain, especially in the Willamette Valley? We've got a lot of manufacturers and food producers on the call, so. Yeah.
I've actually just been involved in this in a couple different conversations because, obviously, if you look around the country and look around the world, food security issues have been a particular problem. A lot of these large coat processing plants, for example, you have high levels of COVID and shutdowns. And what we want to do is to the extent that we can, learn from those examples and take advantages of them to create more resilient processing mechanisms that maybe have a higher value added associated with them as well. So one of the things I've noticed is people talking about how, sure, they see plenty of food at the store, plenty of meat, and it's all locally produced, product that's basically more humanely treated, organically grown, smaller slaughterhouse facilities, those types of activities that you have more control over. So the idea to enhance some of the branding we have among this, among these products, at the same time we deal with the safety issues of these products. I think you probably have room in that space to grow in this kind of event. So things that we already have advantage in, we should try to exploit those advantages when we get them. And there's going to be some issues here that probably need some coordination activities at a broader level. Is that right now crops are growing. There's demand outside the country. How do we connect those two things? How do we continue to make working conditions safe for in the agricultural industry, and how do we make sure that we can get our products out of Oregon to where they're supposed to go? And where is the state leadership, for example, in saying, okay, this is the problem we need to solve. Let's just solve this problem, because I don't think any of these things are unsolvable without some vision and without some leadership. And I've seen examples of that start to emerge across the state. And we sort of have to stop thinking about what's impossible and start to think about what's possible and making that happen.
Got a couple more questions. What guidance could you offer for local governments that want to offer business assistance?
Okay, so this is an excellent question. And I'm very wary of putting the cart in front of the horse on the business assistance issue. So early on, there was some grant programs locally that distributed for sort of, I think, nearly $500,000 money, most of which I'm sure has not really made much difference because of the extent of the downturn and the damage done. To my mind, local governments and the business community need to coalesce around a plan to make their community safe. That has to be the #1 objective. So if you spend a bunch of money on supporting, business A, B, and C, and you end up closing the economy again in 2 weeks, all that money is gone. All that effort is gone. If we have to shut down the economy in 3 months because we opened it too early, all the effort we're doing right now is just wasted effort. So what we really need to do as communities is coordinate around the public health issue. And that's going to mean developing public health mechanisms to test, trace, isolate infected individuals, be able to do that fairly quickly, and leveraging the resources you have internally to do that, whether they be your higher education institutions or your medical community, to do that, to have a business community that supports that effort. That might mean financially as well as with other resources. So whether you're making your employees available for testing, for example, whether you're supporting community health efforts by requiring customers to wear a mask or your employees to wear masks when they're caring about their duties. That's where I think you need to focus development efforts right now. You can't control the health. If you can't control the public health issues, you can't grow your economy at this point. So that's what we need to be doing.
What about, so for manufacturers who are considering how long the need for PPE, masks, gowns, gloves, that sort of thing, how, it's a big investment to retool. How should they look at the long-term filling that need?
Yeah, this is a really hard question, and I sympathize with firms that are considering to retool because it's not obvious what to do unless you have a customer base that's willing to purchase that for an extended period of time. So what you would want optimally is essentially commitments from, again, this is a coordination issue, right? You'd want commitment from the state and a commitment from your local health community to come together and say, look, this is our anticipated needs over the next 5 years of PPP, and this is our anticipated needs or what we have to build up for a crisis. And so we're going to commit to buying these kinds of supplies for an extended period of time so that you can continue to operate this business and invest in this business. And that's the kind of cooperation we really need to see. Otherwise, you're stuck with this problem that you're seeing, is that we don't want to tool up a new line for a 1 month problem. Now, I don't think in this case it's a 1 month problem. Unless you happen to have a virus or a vaccine quickly, we're going to be stuck with large amounts of people needing large amounts of personal protective gear for a long period of time. So also, how do you support public health efforts to track and prepare for the next pandemic? Because this won't be the last. There will be another one. We've already seen a number of these types of things emerge in the last several years. So we're going to have to prepare for another one, and that would create a market too for preparation. But here's where the risk is, and I understand that, is that, for example, there was a real push to produce ventilators early on in this crisis, and now doctors are saying, well, that's a last resort sort of thing. And so we might not need all these ventilators we thought we'd need. So it's a really tricky space that you have to be cautious for. So again, this is the coordination problem. This is where we need a strong, well-funded public health authority to try to guide us through.
Awesome. That's all the questions we have. Eric, I'm going to turn it over to you to thank.
Oh, you know what? Did everybody get, there's a couple of questions and answers here. Do you have a minute? Do you want me to sort of look?
Yeah, if you want to snag one or two more, it's kind of a lightning round. I think that'd be. Yeah.
So, this is a good question. Can our economy really survive further contained suppression of 6 months or more of business activity? So, no, you will not be able to do this indefinitely, right? We know we have to have a path to move forward, and that's where our economic development goal should be, is to think about, well, what's going to happen, in 2 or 3 months if we get the next wave of virus. Are we going to have to shut down again, or are we going to have a plan of how we're going to contain that quickly? So, we can limp along for a long time here with federal government support, but we're not going to be able to limp along either, economically or psychologically forever. So we need to think about how do we avoid having to be in this situation, because it's really an untenable situation overall. Yeah, I think the rest of these are kind of ones that I might not know as much the answers to. So I'm going to take a pass on some of these health-related ones that you're going to have to find an epidemiologist to deal with.
Let's see if we could do that. Eric, do you want to close us out?
Sure thing. Well, first of all, thank everybody for tuning in, and thank you, Tim, for always a interesting discussion this year, obviously with a really different flavor to previous years. I know there's still a lot of questions that we don't have answers for, but hopefully we'll be in a position where we can continue to offer this type of information to our members and other members of the community that are interested in kind of hearing from experts. The recording of this event and the handouts will be on our webpage, on our SEDCOR.com/events page and the SEDCOR site. Please keep in touch with us on LinkedIn and Facebook as well. We're constantly trying to keep updated information and trying to at least add a little bit of a filter so that you're getting good information that's already in place and available for businesses, because there's a lot out there that we're trying to sift through and trying to highlight the the most applicable information for our members and our community. Also, we are having a forum again in June 10th. The next forum will be presented by Sherman, Johnny, and Hoyt. Once again, interesting topical information. We'll have 2 speakers, one covering what you need to know about Oregon's new business sales tax with Steve Elzinga, who's an attorney at Sherman, Johnny, and Hoyt. And also what's next, recent changes in the Oregon employment laws with Justin Thorpe, another attorney at the firm. So thank you for their support, and thank you for the Oregon State Credit Union, and very happy to have you be part of our experiment here today with our event. We do have registration for our next forum already open on our website, so you'll be hearing more about that soon. Be careful out there, stay safe, and hope you're the next few weeks start to see some good turnaround and hopefully some money flowing again, and we look forward to working with you to try to keep our economy going and growing in the future. So thank you very much for attending today.